A very good evening to you all, friends. I am Sanjeev Singhal, Central Council Member and Chairman of the Auditing and Assurance Standard Board. On behalf of the AASB, myself and my Vice Chairman, C.A. Vishal Bhai Doshi, I welcome you all to the 121st program of AASB for this council year. It's been our endeavor to keep our members updated. That's why on different topics pertaining to audit, we bring to you different speakers. So today we have this session on key consideration in audit of NBFC, and our speaker for the day is C.H. Chinnaswamy Ganeshan. I know Ganeshan now for almost 2 decades, and is a thorough professional, very well experienced both in industry and in profession, has been serving the alma mater Institute of Chartered Accountant of India in various capacities. He's been a co-opted member and special invitees in some of the most important committees of the Institute of Chartered Accountant of India. Very vast audit experience and the overall professional experience. Is a friend of the profession, is just a call away. Whenever we need him, he's there, as slim fit as ever, as young as ever. And you know, his contribution to the profession is really great. So I'm sure that the participants will have a wonderful experience listening to the nation and his insights into this topic. So thank you, Chinnaswamy Ganeshan, for taking out time once again for the profession. And may I request you to kindly start your deliberation.
Thank you, Chairman, for giving this opportunity again to meet all our friends in some important topic, especially when we were talking about the audit of non-banking financial companies. One sector which is catching up, and it is actually becoming more and more important for the economy, is also non-banking financial services companies. And of course, when we are talking about non-banking financial services companies, there could be variety of non-banking financial services company. Maybe a housing loan, a loan, maybe the primary objective, or maybe something will be only investment company, core investment company. Something can be just non-deposit taking, and it provides only some sort of financial services alone. And variety of activities could be carried out by a non-banking financial services company. But the interesting factor when in the audit of a non-banking financial services company is that not only the accounting and auditing framework has to be looked into, but the regulatory framework or the environment in which NBFCs are operating is also very key for conducting an audit of this type of companies. For a simple reason that there is a market regulator who is looking at the NBFCs, and it is framing the laws, regulations, the way in which they have to function, the way in which their activities should be monitored, supervising their roles, reviewing the activities, inspecting the documents and the records, and also giving updates on a regular basis to ensure that the NBFCs, being a backbone of economy to a greater extent, are not failing just like that because of a non-governance. So accordingly, both the auditing aspects, accounting aspects, regulatory aspects, of course, the corporate governance aspect is also very, very key when we are considering the audit of NBFCs. And this being a session organized by AASB, I thought that the session should be structured in such a manner that rather than focusing more on the corporate governance or the Companies Act perspective, it should be able to touch the key considerations in an audit of NBFCs. What are all the major drivers or major areas of focus for an audit of NBFC? And what are all the regulatory framework in which we have to look at? What is the role of an auditor? And what type of guidance which is provided by the Institute of Chartered Accountants of India for carrying out an audit of NBFCs. You will be aware that the technical guide on audit of NBFC, which was issued long back, has been very recently reviewed and an updated version of the technical guidance has been issued as 2023 version, which gives a complete guidance of how an audit of an NBFC and what are all the special considerations which you have to look at when you wanted to understand and the functioning of an NBFC, how you have to structure your audit, etc., will be really being narrated or illustrated in an exhaustive manner. So my sincere suggestion is to look at that technical guide whenever you are planning or performing in your role as an auditor of an NBFC. In fact, not necessarily for the statutory central audit, even for the branch audit, when you have been assigned a branch of the NBFC and you are doing an activity, the technical guidance will be helpful. And of course, to some extent, it will also be helpful to carry out the important areas which has to be necessarily covered in the risk-based internal audit function of an NBFC. So with this prelude, what I will do is I will just carry out the role, what has been assigned to me, by looking at the various aspects of this presentation. The first thing which I wanted to talk about is basically, you know that the standards on auditing issued by WASB and of course made as part of the Companies Act 2013, because many of the NBFCs are governed by the Companies Act 2013 as they have been registered under the Companies Act 2013. So one of the main requirement in an audit of an NBFC and the fundamental principles when we were talking about starting an audit is to understand the business and of course to understand the laws and regulations and what are all the risks associated with that risk assessment, SA 315, and of course responding to the assessed risk. If you are looking at these four fundamental standards on auditing, understanding the client's business and the environment in which it is operating, understanding the laws and regulations applicable to the particular entity, and what is the assessment of the key risk with respect to that particular entity, and what is the responses of the auditor based on that, the auditor will be able to plan and perform the audit procedures required to obtain the required audit evidences, or maybe I can use the word to obtain sufficient appropriate audit evidence, and that audit evidence will be forming the basis for issuing an audit opinion. So accordingly, when we talk about the business of an NBFC, we know that they are like banks, but only difference is they are not covered by the Banking Regulations Act, but they are carrying on non-banking financial services. So it's a financial services company other than banks. And the regulations which are normally covered for are normally covering a bank will also be extended to a non-banking financial services company. So the principal regulator here is the Reserve Bank of India, like for banks. And accordingly, whatever circulars, notifications, guidances, or principles, master circulars, etc., issued by the Reserve Bank of India will govern basically the way in which NBFC will be operating its activities, the way in which NBFC conducting the management of its assets and liabilities, or we call it as A&L, because normally we will not worry about how they are managing their assets and liabilities, but we are specifically required to look at the assets and liability management as well. And of course, what are all the corporate governance framework required, like a audit committee, what is the functions of the audit committee? What is the ALCO committee, that is the audit, assets and liabilities committee? What is the risk management committee? What is the role of NRC? So all these requirements are basically may be governed by the Companies Act, but it is almost the guidance is given by the Reserve Bank of India. Accordingly, we should first understand when we were doing an audit of an NBFC, the laws and regulations prescribed by Reserve Bank of India is the primary concern or primary area of focus in an audit of an NBFC. The reason is how you are looking at the way in which the capital adequacy has to be maintained. What are all the rules and regulations which has been formulated by the RBI should be looked into. And of course, the prudential norms issued by the Reserve Bank of India for the banks will also apply to NBFC to some limited extent. When I'm saying limited extent, because majority of the non-banking financial services companies will get covered by Ind AS. So if they are following AS, they are still under the prudential norms. To that extent, they are following Ind AS. The prudential norms are taken by two different requirements. One, as far as the income recognition is concerned, Ind AS 115, revenue from contract with customers, will prescribe the requirements for recognition of income, how it should be recognized, the timing of the income recognition, how the income recognition should be quantified, etc., should be governed with respect to the first part of the prudential norm. The second part of the prudential norm, asset classification, IRAC, income recognition and asset classification, the prudential norm, that asset classification, even though we are talking about non-performing asset, or we are talking about doubtful asset, we are talking about loss assets under IRAC norms. When it comes to the case of a NBFC following Ind AS, that norms are taken over by Ind AS 109, financial instruments, the financial instrument standard Ind AS 109 requires how you have to classify the various categories of the financial assets and financial liabilities, as well as how you will be providing for the expected credit loss. So the expected credit loss will be substituting the provision required under IRAC norms for a normal NBFC. That's the reason why I'm saying that the prudential norms will be different for an NBFC which is following AS and an NBFC which is following Ind AS. But majority of the NBFCs, which I believe, which we are supposed to discuss in this forum, we assume that the financial reporting framework they follow is Ind AS, so that we will not have any doubt over how we are working out. When we were talking about the accounting issues, which is arising during the course of an audit of an NBFC, we'll discuss a little later. The next point of the laws and regulations, when we understand, it is not just enough to look at the rules and regulations, but we should also look at the various circulars and master circulars which are issued by RBI for the purpose of monitoring the activities of NBFCs. That is also very, very important. One simple example which I can talk about is that even though there is no, under the Companies Act, the rotation of auditors are based on Section 139. Whereas when we were talking about the NBFCs, Reserve Bank of India for certain levels of NBFCs are suggesting that the auditor should be appointed over a period of time. So there should be a mandatory change of the auditors over a period of time. So accordingly, the monitoring of the entire activities of an NBFC, including what has happened in the operations. For example, there is a fraud which has happened in that particular NBFC. Reporting of the fraud to Reserve Bank of India is also one of the critical aspects based on the monitoring. And the NBFCs are also being closely monitored by RBI by doing an inspection on a regular basis. So as an auditor, we should be cautious that when we do an audit of an NBFC, we have taken care of all the circulars, master circulars, rules, regulations, etc. relating to an NBFC. Otherwise, the RBI inspection is coming out with certain observations which are relating to an audit, we will be definitely questioned for not carrying out our activities in accordance with the requirements of various standards on auditing. And of course, maybe we will question for our negligence or professional negligence. So accordingly, it is very important to understand each and every circulars monitor the master circulars being issued. And another important aspect is that two aspects I should say. One is a registration which is required under section 45(1)(a) of the RBI Act 1934. This 45(1)(a) of RBI Act 1934, you will be familiar with that. Without this certificate, no NBFC shall commence its business or carry on the business of NBFC. So this is very specific certificate, and you might have evaluated this in respect of your normal reporting under CARO also. CARO 2020 is also asking whether the company is required to obtain a registration under section 45(i)(a) of the RBI Act 1934, because there are parameters 50-50 test which we are talking about. What is the financial assets composition, whether it is more than 50% is composed of financial asset, whether the income is more than 50% arising from the financial asset, etc. This is some test which we normally try to do, even for a normal company, to see whether they are falling under the category of an NBFC. So this is a continuous assessment which we are looking at, whether they are holding a valid certificate under section 45(1)(a). The second important requirement which we look at is minimum net own funds criteria. And of course, the RBI guideline says that the minimum net own funds could be shall be 25 lakhs or any other amount as may be prescribed, and may not be more than 100 crore or something like that. It is prescribed, but the actual amount prescribed under the rules presently is 2 crore rupees. So the net own funds minimum should be 2 crore rupees. And how the net own funds has to be calculated, there is a circular which has been issued by RBI. So accordingly, at every point in time or every audit closure, the auditor should validate the valid certificate being available. The second is the company is also having a minimum net own funds criteria. Let me take one small example for us to understand this aspect a little bit. We were auditing an NBFC, and that NBFC is a listed company. And that NBFC has given certain loans to group companies. There are some restrictions for giving loans to group companies when you are calculating the net own funds. When these loans have been given, the first consideration is as a related party transaction, whether all the parameters have been taken into consideration. But of course, when we say that the normal course of business of the NBFC itself is to give loans, so the particular transaction is not specifically covered by section 188 of the Companies Act 2013. That could be one way of looking into that. But at the same time, the problem which we are having is how the related party is operating, or how the strength of the related party is also should be looked into. Like what you are trying to assess, whether a provision is required or not. In that particular situation, what has happened was the loan given to the major customer is normally being served, but all of a sudden that particular customer case has been referred to NCLT. Because it is referred to NCLT and a resolution professional was appointed, the first question which comes to our mind is that how the amount will be recovered in the case of, for example, if there is no resolution plan, whether this amount is recoverable. And this amount being given by a related party, NCLT provisions, when we were talking about the resolution plan, there is a possibility that the least priority or the last priority will be given to those related party transactions. And accordingly, the first question which came to our mind was, what is the impact of this particular amount, whether to be provided for or not? The company was saying that we are ready to take an audit qualification, but we are of the feeling that this amount is fully recoverable because one, so far it is being servicing the interest as well as the principal repayment. There is no other issues which we have seen. The second is the investee company or the borrower is also having very solid assets, which is, of course, it is not secured loan. The amount, when even in the case of a liquidation of that company, the amount will be much more than what is the liability they have for outsiders. And accordingly, the entire amount is fully recoverable. It's only a question of time. So the question of time under expected credit loss, whether I have to make it as a provision. If it is an IRAC norms, I will definitely say that because it is more than 3 months, 90 days norms, we will apply and then we will say that it's a non-performing asset. The moment I am classifying that as part of Ind AS scenario, my question is whether the amount is recoverable or there is a credit impairment or only significant increase in credit risk. On those assessment, what we have concluded is that in our assessment, there is an increased risk of credit, and accordingly, ECL has to be considered even for those items at a higher level, like a stage 3. But the company is of the feeling that stage 3 requirement is not there. You should only consider that as a normal unsecured loan and make a normal provision. That is the company's stand. We have said that we will qualify, but the company said that you can go ahead with the qualification because we are confident that we will recover that money. Now the problem came was, if the provision has been considered in the financial statement, what is the impact on the net owned funds criteria? Whether it is less than the 2 crore rupees or not, whether the auditor has evaluated that also is the additional consideration. We have evaluated and we said that subject to our observation with respect to the qualification relating to non-provision for this borrower who is under NBFC, NCLT provisions. If that provision has been made, then the company's net owned funds will be lower than the limit, and accordingly, the company cannot carry on the business of NBFC. If the company cannot carry on the business of NBFC, automatically the concern on continuing as a going concern also applies. So the audit report considered both the regulatory requirement of net owned funds. Because of that, whether the company will be able to continue as a going concern, because the certificate will automatically be deleted in case RBI is initiating proceeding. And how the accounting principles with relating to that particular loan has been considered. So it is not a simple consideration of a particular item when it comes to NBFC compared to what I might have considered with respect to a normal company because of the laws and regulations. So keeping that in mind, the laws and regulations as the key criteria, I was looking at what are all the other aspects which I have to consider before coming into the main aspect. What I believe is that we should have a tailored audit approach. In fact, when I'm sitting as an audit committee chairman of some NBFCs, the approach made by the auditors, statutory auditors, is being questioned by the members of the audit committee. And we are asking them to demonstrate how they are planning their audit, how they are carrying out their audit, how they are able to arrive at a conclusion on the financial statements. The reason is the approach is moving from a traditional approach to a tailored approach. For example, in a traditional approach, you normally look at a transaction, whereas now the entire aspects are moving towards business risk-based approach. For example, even internal audit, risk-based internal audit approach is being suggested for NBFCs. And accordingly, when I am talking about an NBFC audit, if I am only looking at the transaction-based audit, it may not be of a real help. I should look at what is the business risk associated with the NBFC and how that business is being managed by the entity, and what are all the key business drivers or risks which will drive the business, and how my audit procedures are being addressing those issues. That's the reason why I said that you assess the risk of material misstatement and respond to the assessed risk. This is nothing but coming from the business risk-based approach. Again, you normally go with a periodical or an audit plan approach in a traditional method. Now, because of the changing regulations on a day-to-day basis, every day there is a circular comes in. Every day there is a new requirement which an NBFC has to follow. You are required to look at a real-time as business cycle-based approach. In fact, the business cycle-based approach, I will also take it up along with the discussion on expected credit loss model, because for an Ind AS companies, the RBI has given certain concession, even though they are determining what is stage 1, stage 2, and stage 3 assets for Ind AS 109. They have also given certain business considerations. Calculating expected credit loss. So that is also another important aspect where the tailored approach may be required for the purposes of an NBFC audit. And again, control whether it has to be enhanced is a traditional approach, whereas we are looking at, because the client is also looking at, what is the focus or how the business performance can be enhanced. Management is looking at how the business performance can be enhanced. The moment management is having the feeling that business performance has to be enhanced, naturally there will be a possibility of issue arising that because of business performance consideration, the other consideration may be taken a slight back seat. When it takes a slight back seat, there is a possibility of non-compliance with the various laws and regulations, non-compliance with the controls requirement, maybe overriding of controls, etc., could be possible. Another interesting factor is traditionally we do a test check or sample basis, but nowadays when we are talking about an NBFC, data analytics is essential for carrying out an audit of an NBFC. I'm using the word essential, or maybe I can use the word critical for an audit of an NBFC, because your sample data cannot give you comfort to conclude on your audit opinion. For a simple reason, the volume of transaction an NBFC will be having is much, much higher compared to what you are seeing in a normal company. And accordingly, covering all the population with a reasonable sample size will be a difficult task. Whereas by employing data analytic tools, you can review the entire data for your control testing, your compliance testing, your accounting aspects. Everything can be taken into consideration. In fact, I have seen in one of the audit committee, the auditors have presented that they are happy with the accounting or the financial statements level, but they have suggested certain improvement points in the operations of the company based on their data analytics. One of the consideration which they have identified is that they have seen that the controls which they are having, the data analytics, I will let you know why that is more and more important, is that majority of the functions of an NBFC is data driven or system driven. So they spend a lot of money on IT infrastructure and IT management, because it is impossible or practically impossible to manage on a manual basis. The moment you are relying on the system or you are relying on the IT controls, naturally, if there is a possibility of a loophole in one of the IT general controls or maybe application control, it will be an issue. The auditors, when they have looked into, they have said that where you have to look at the classification to arrive at So say, for example, when I am saying one of the, you know that in banking case, when we analyze the NPA analysis, borrower-wise classification is important. So if one borrower is properly repaying its term loans, etc., but in the working capital limits, they are not performing. And accordingly, the entire risk or entire facilities they are enjoying, including the term loan, should be reclassified into non-performing asset. That's what your IRAC norm says. Extending the same language or same concept to our Ind AS 109 on expected credit loss. The moment I have considered one loan as credit impaired or increased risk of credit, I cannot say that the other borrowings by the same customer is a normal credit. There is no significant increase in credit risk. I cannot say, right? So the same logic should be applied in building the model of Ind AS 109 expected credit loss. They have identified that the IT structure or the IT controls or the flag which they have been identified during the data analytics is that borrower-wise tagging is not available. In other words, they have picked up cases based on data analytics. Same borrower is having more than one type of facility, and though some of the facilities are considered in stage 3, and some of them are considered under stage 2, and some of them have considered even under stage 1. So they believe that if the borrower-wise classification has been properly tagged, it is possible. So now the worry comes in is the controls are weak or the application controls are not operating effectively. That will be coming out only based on your data analytics. The immediate next question which we have asked from the audit committee is that how they are comfortable that this is not resulted in a material misstatement on the financial statement. Then they have explained that based on the amount, the number of cases they have identified, based on the number of cases identified and the amount involved and the provisioning requirement, the amount is not material to the financial statement. So risk of material misstatement has been taken care. But there is an inherent risk that in the near future, if the amount or the likelihood of this mistake continuing for the other items, the likelihood of the issues may be higher in respect of these particular cases. That's the reason why we are believing that data analytics is an important aspect for an audit of NBFC. Of course, I have narrated how you are trying to do the data analytics. Again, understanding the business and key business drivers and top-down risk-based approach and evaluation of the risk of material misstatement and carry out your, this is a tailored approach which we are talking about. Carry out your test of control over individual processes and the financial reporting framework. And of course, carry out your audit procedures on key focus area, wherever there is a management estimates involved. And wherever you have to use an expert, for example, in a tax or maybe infrastructure, IT infrastructure, or maybe in some other claims which has been made on the company, legal items, etc. And what is the interim findings during the course of your audit, and based on which how you are updating your audit strategy and audit plan in accordance with the standards on auditing, and carrying out this nature, timing and extent of audit procedure to ensure that you are managing it properly, based on which you will conclude on the audit opinion. It's a simple audit procedure, nothing new. We follow the same principles for normal company. The added issues which I have listed out is that your laws and regulations, and another is the volume of data which you have to look at, and accordingly using data analytics could be one of the important tools. And another area which I have seen as an important requirement is you should have at least one person in your team who is capable of doing an information systems audit procedures. In fact, in majority of the NBFCs, they will be having their own internal audit team which will be evaluating the information systems controls, both ITGC as well as the application controls. But still, as an auditor, you should evaluate the work done by the internal audit team of the client, as well as the information systems audit if it is conducted by an external consultant, and also arriving at their own conclusion, that the auditors, statutory auditors' own conclusion on whether there is anything which has to be looked into further. That's the reason why I believe that the knowledge of information systems audit is also key in respect of a non-banking financial services company, mainly because of system-driven transactions. Each transaction is captured and it goes further and further on that. And this is what I have talked about on data analytics. Naturally, when you are engaging the technology, you are embedding the technology along with your audit procedure. So naturally, it will result in a high quality audit. Data is extracted from the system, and this extraction of data is for a specific audit needs. So wherever I wanted to do an analysis with respect to, say, for example, my estimate on expected credit loss, how the performance is being happening. Whenever I wanted to analyze how the performance of the company relating to controls and other aspects relating to advancement of loan, monitoring of the loan, collection of the loan, etc., how I am doing, and the data relating to monitoring of the various adherence to RBI norms, etc. Depending upon the various circumstances, you can extract data from the client and analyze the data based on your data analytics. And the moment you have identify some exceptions, you can actually analyze the complete data sets for the purpose of understanding whether there is any business reasons for the exceptions or it is override of the controls environment. And accordingly, it gives an improvement for the auditor for a collective business intelligence. And accordingly, the audit will becoming more and more qualitative, and the exceptions will be identified, control weakness will be identified, and accordingly, what would be the implications on the risk of material misstatement can easily assessed by the auditor. So this is the major framework at which we are looking into. Considering the time factor, I believe that let us look at some of the main areas of concentration required for the purposes of a non-banking financial services company, apart from laws and regulations, etc. The first point which I wanted to look at is allowance for expected credit loss. When I say allowance for expected credit loss, as I have mentioned that I assume that the NBFC is under IRAC, is under Ind AS framework, and accordingly, it will be calculating the expected credit loss in accordance with Ind AS 109. Now, what are all the requirements of Ind AS 109? A model should be developed for determining what is the expected credit loss by maintaining the portfolio by the NBFC. So the past trend, current development, and what is expected to happen in the near future, considering even the macroeconomic factors which may have an impact on the repayment capacity of the borrower. We factor all the items and arriving at a model. Now the question comes is that whether the allowance for expected credit loss is a real concern for the audit of an NBFC. My answer will be yes, both from the management perspective as well as from the auditor's perspective. Let me first look at the management perspective. RBI has given enough guidances and enough circulars that the expected credit loss model, how it has to be developed and how it has to be verified, how the management should be comfortable with the model. In other words, they have given this responsibility to the audit committee of the NBFC. Audit committee has to evaluate the policy relating to expected credit loss, and based on which the board should approve the policy relating to expected credit loss. The moment I say that there is a explicit responsibility to evaluate and approve the policy relating to expected credit loss under the RBI guidelines. If the management has not carried out this, or there is a mistake in the way in which expected credit loss has been estimated and provided for, there could be a possibility of the management being questioned by RBI inspection. That is from the point of view of the management. When it comes to the auditors has to consider that as a significant estimate. In fact, if you see, for majority of the NBFCs, the key audit matters which the auditors are referring to in their audit report as per SA 701 will be expected credit loss also, because significant estimate. It falls on three parameters. If you looked at the requirement of 109, what is the probability of default you have to determine? What is the exposure which you are having as of now? And what is your loss given default? Three parameters, multiplication of all the three will give you what is the amount of expected credit loss to be provided for. When I say that the probability of default, exposure at default is very simple. Exposure at default is nothing but what is the amount outstanding in your financial statements or your books of accounts. But the probability of default has to be looked into based on some models. The normal model people are trying to look at is what is the rollover rate for a particular loan from being within 30 days. If there is a default which is occurring, whether the default is moving from 30 days bucket to 60 days bucket or 90 days bucket or more than 90 days bucket, etc., is trying to look at. So rollover rate is one of the determination. For the rollover rate, past data is critical. So the source of the past data, because in audit, normally estimate being questioned for a simple reason. What is the source data from which the data has been picked up for the purpose of determining the estimate? Have the auditor verified the correctness of the source data? So accordingly, the primary audit consideration for expected credit loss will be to look at the source of the data, which has been taken maybe from the IT systems, and also the past trend of the movement from one bucket to another bucket, etc. You have to look into. So that is one important aspect. Normally, there will be a lot of issues arising out of it. You remember that I was mentioning about RBI has given certain flexibility on this. For example, if an NBFC is giving loan only for agricultural operations, so there could be a possibility of you looking at the business collection. Normally, say for example, 90 days, I consider if it is not collected, there is an increase, a significant increase in credit risk is what I will conclude. But whereas if it's a crop loan which has been given, naturally in a bank audit, you will know that one crop season is what you are looking for as a default, right? So accordingly, when determining the model for arriving at the expected credit loss, an LTD can also consider the business aspects, how they are estimating a particular loan will become significant. There is an increase in significant credit risk with respect to a particular loan portfolio. You can actually look into that particular aspect as well. They have given some flexibility. Only thing they are very particular about that. When you are giving a presentation and disclosure, you have to follow the principles given in RBI. And if you are considering the credit loss model, say for example, 180 days rather than 90 days, one crop season is 180 days, then you have to explain the logic behind that particular parameter being applied. So there is some flexibility, but you have to be careful whether that flexibility can always be applied, or you have to look at on the normal peers performance to look into this as well. So this expected credit loss, the second major consideration which you have to do as an auditor is that another parameter is out of the loss which I have already incurred, how much I have collected, or what is the capability of collection or efficiency of collection. To that extent, even if there is a probability of default, I could be able to collect a portion of that default amount. And accordingly, there is no provision required to that level. So, say for example, out of say 10 crore which I have written off in the previous period, and I have collected 2 crore. So 20% efficiency is there. So I have to look at my loss given default is only 80% and not 100%. So to that extent, the final percentage to be applied on my probability, my exposure at any point of time may come down. But the significant portion of these items are basically having two problems. One, all these items cannot be manually calculated. So either it will be using a software-based calculation, and I have seen majority of the cases, it is not even software-based calculation. It is based on Excel spreadsheet calculation. The moment Excel spreadsheets are coming into the picture, you know pretty well, according to the standards on auditing, you do not have any control over the spreadsheets. And accordingly, how the auditor gets a comfort that these spreadsheets are not manipulated, or maybe I can say that manipulation is a too big word, intentional. It may be unintentional or intentional errors which are capable of being inherent in the spreadsheet. How the auditor has audited the spreadsheet should also be looked into. Source data, Excel spreadsheets, business activity, past trend, what is the macroeconomic principles. All these aspects the auditor should necessarily look into for a simple reason. This is one of the significant estimate the auditor will be auditing in an NBFC. Okay. Now there could be scenarios of expected credit loss being looked into differently by different NBFCs. Disclosures may be different, but if you look at the model developed by them and validated by the audit committee and approved by the board, you will find out the business reason behind that. That's the reason why whenever an NBFC is creating a expected credit loss model, a proper disclosure as required by Ind AS should also be made by the company in its financial statements. And you are aware that as an auditor, as per the standards on auditing, not necessarily the numbers alone to be audited, but also you have to audit whether the required presentation and disclosures are part of the financial statement. Otherwise, SA 705 says that you have to evaluate whether the auditor should modify his audit opinion. Okay, that's the first consideration. The second consideration is, in majority of the NBFCs, there is one interesting factor which they are considering is direct acquisition of portfolios or direct assignment of portfolios. When I say direct acquisition or direct assignment, you know pretty well it is nothing but securitization. So I have a portfolio of housing loan, but I don't want to maintain that for the next 20 years. Somebody else is ready to buy that portfolio by paying me upfront. So in that case, how the upfront transaction can be accounted for is a validation an auditor should look at. For two reasons again. One, if you look at majority of the financial statements of the entity, and especially listed companies, you can observe this type of changes. Quarter on quarter, when you are saying the direct assignment or direct acquisition will be very minimal. In the last quarter, the direct acquisition income might be very, very high. The reason is, it's an easy way of recognizing income upfront. Instead of recognizing over 20 years period, I can recognize upfront the surplus which I have made out of assigning the entire portfolio to a third person. So what is the audit considerations arising out of the direct assignment when I am assigning my portfolio to others? Similarly, I may be purchasing the portfolio from other companies on a direct acquisition. So where I wanted, say for example, there may be a requirement that I should lend on primary sector. I may not have identified that, but whereas another company was available to give me that particular area. So I'm purchasing those portfolio here. So either I purchase direct acquisition or I sell direct assignment. What is the audit procedures which we have to look at is very, very serious implications will arise, because it may result in a significant or maybe risk of material misstatement if we are not auditing it properly. That is the reason why looking at the contracts for direct assignment or direct acquisition and what are all the terms and conditions attached to that, is there any reason why we believe that this direct acquisition or direct assignment will not meet the criteria of, say for example, let me say it's a direct assignment. I'm actually removing the financial assets from my books of accounts, right? When I'm removing from my books of accounts, whether derecognition of the financial asset is possible in accordance with Ind AS 109, that should also be assessed by me. If I'm not assessing that, there is a possibility that I cannot recognize the income upfront if it is not meeting the criteria of Ind AS 109. The auditor should look at that first aspect. The second aspect is whether the direct acquisition or direct assignment is being used for the purpose of meeting the performance pressure. In majority of the cases, I believe that to meet the performance pressure only, the direct acquisitions or direct assignments are being carried out. So if it is a performance pressure which they are having, naturally, the auditor's professional skepticism, according to the standards on auditing, should be very, very high. And look at the business reasons behind this particular accounting aspects as well. That is one. And the next issue which we have to look at is that it may be connected with your expected credit loss, but the way in which we are looking at that, whether the entity can continue as a going concern, we look at what is the items which are due. We call it as a par 1 day, or 1 installment, 2 installment, 30 days. So what is the variation which is happening and where I am standing with respect to my default or delinquency levels compared to my peers is one of the analysis which the auditor should always look at to understand that the company is capable of continuing its business and there is nothing to worry too much on its capability of collecting its debts. And of course, compliance with all the RBI norms, provisioning norms. You may look at this and ask me a question. You already said that expected credit loss is what you will require to provide for. Why you are looking at RBI provisioning norms? Interestingly, for NBFC, RBI has said that they have to prepare the provision in accordance with the expected credit loss, and they should also parallelly look at what is the requirement of provision under the IRAC norms, prudential norms also. Suppose if my provision under IRAC norms is, say, for example, 100 crore, and my expected credit loss in accordance with my Ind AS 109 is only 90 crore. The balance 10 crore, I am supposed to make an additional provision in the books of accounts. The reason is they believe that at no point in time your provisioning under IRAC norms could be lower than this. Okay, on the other side, suppose my IRAC norms provision required is only 80 crore, whereas my expected credit loss model provision comes to 100 crore. Can I reverse this? The differential amount, can I reverse it? They simply say that no, the excess provision, if you are holding anything under IRAC norms, should be kept as a separate reserve. And of course, the moment you are carrying it under separate reserve, the question comes is whether it will be considered for your capital adequacy ratio. tier 1 capital or tier 2 capital, they are saying it can be considered as part of your tier 1 capital. But that is one thing which we have to look at. RBI provisioning norms should also be parallelly considered for the purpose of comparison. And again, loans to related parties, as I have mentioned, that there is a restriction on how much loan you can give to related parties, how much exposure you can have to related parties. And the moment you have given any loan to a related party, the net own funds calculation, there is a procedure of taking an amount or percentage, and that is also to be looked into. And another interesting requirement as per RBI guidelines is that every NBFC should create a statutory reserve of 20% of the current year profits. So the moment I say that it's a statutory reserve, there's an appropriation of funds. So accordingly, it should be created and has to be taken to the reserve. We should always ensure as an auditor that the required provision has been made. Coming to the next asset side, the investments made by the NBFC may be various types of investments could be possible. Group companies, pass-through certificate, non-convertible debentures or convertible debentures, debt fund. Maybe in all these aspects, the major requirement comes into is how you have audited the recognition, measurement, presentation, and disclosure of these financial assets in accordance with the applicable financial reporting framework. So, under Ind AS 109, the financial asset has to be classified into 3 categories. One is amortized cost, another is fair value through P&L, another is fair value through OCA. Apart from that, if I have made an investment in associate, joint venture, or subsidiary, there is a possibility of I am going by Ind AS 28, where I can recognize them at a cost model. But with all these things, if I say that I have made an investment in non-convertible debenture, whether the non-convertible debenture has to be carried out at its original value, that is the face value, or it should be carried out their amortized cost model under Ind AS 109. So because NC, non-convertible debenture has a fixed maturity date, and it meets the criteria, what we call it as a solely payment of principal and interest criteria under 109, it will be classified under an amortized cost model. Have you audited the amortized cost working of the client and the discounting rates which the client has applied, and whether there are any items which you have to consider where they have given at lower than the market rate? So all these aspects you have to look at for the purposes of determining this for amortized cost. The next interesting factor which you have to look at is fair value. And of course, fair value is made very clear. It should be fair valued as per Ind AS 113, fair value measurement. Only aspect is whether you can take it through P&L or take it through OCA. But the fair value determination may be challenging in some of the cases where it is not actively traded, or maybe it is not a quoted investment. So all the concerns which we are having, again, for the purpose of fair value measurement, is auditing significant accounting estimates. And accordingly, all the parameters required for doing that audit is also to be considered. On the liability side, when I have taken some securities or debt securities, maybe I have issued some bonds, or I have taken some borrowings, or I have taken certain items at lower than the market rate, what type of accounting issues which auditor has to consider in the audit of an NBFC is also a very interesting factor. The first point is that I believe that there is a very simple accounting principle when it comes to non-convertible preference shares or non-convertible redeemable debentures. But the moment you are talking about non-convertible you are talking about compulsorily convertible preference shares. Majority of a narrow opinion is being drawn that CCPS is always considered as a financial liability, because the way in which the agreement has been drafted, there could be some element where the exit plan has been given for the investor. That exit plan has been very narrowly interpreted that this will be an outflow of resources by the entity, and to that extent, CCPS will be a financial liability. But my suggestion is, please assess as an auditor each and every terms and conditions of CCPS and assess whether they have to be considered as liability or there is an equity component which has to be shown separately. So please do that. And when we are talking about this borrowings, the interesting factor is that, for example, if I have incurred the processing fee or I have incurred certain cost for acquiring that particular loan, that cost has to be spread over the repayment period, or otherwise I should say that by accounting for the borrowing cost should be based on effective interest rate method. So the related validation should also be made by the auditor. One second. There is one message comes from the WSP. Okay, so the aspect which is coming in is basically how we are auditing the effective interest rate model with respect to my debt securities and other borrowings. Especially, one simple approach I can tell you is that whenever a particular liability is having an interest rate less than the market rate, then automatically your accounting for effective interest rate model comes in. Otherwise, your contracted rate will be equivalent to the market rate. You can simply assume that and no further adjustment is required other than your processing fee. In processing fee also, sometimes we take a call that if the processing fee being spread over, say for example, 10 years or 20 years, depending upon the loan period, the impact on the financial statement is not material. It can be still ignored on materiality, because the auditing standards very clearly says that the every evaluation should be based on the concept of materiality, and Ind AS is also applicable based on the concept of materiality. If the impact is not material to the financial statement, I can simply ignore the accounting for the processing fee over the loan repayment period under effective interest rate method. But take a conscious call whether it will result in a material misstatement or not. That is one of the important aspects which you have to look at. This on the investments and liability side I have mentioned. On the expenditure side, how we are going to do an audit. Very interesting aspect is that your interest income should also be recognized based on effective interest rate model. I have seen two situations. One, in respect of NBFC who are following Ind AS, how they are accounting for the effective interest rate model with respect to various charges. For example, they collect processing fee, they collect some upfront charges, they also collect some documentation fee, etc. And they offer, say for example, 8% interest rate or maybe 7% interest rate. With all these collections they are making, upfront collections which they are making, there is a possibility that the effective interest rate which they are earning is not just 8%. It may be 8.5% or 8.9%. Because when they are pricing a product, they normally look at both the aspects, right? What I earn upfront and what I earn over a period of the loan. Both they are actually look at, and accordingly the product is being priced. So when we look at that in an NBFC scenario, the expected revenue which you collect upfront has to be factored in arriving at what is your effective interest rate income to be recognized under your accounting financial reporting framework. The auditor should necessarily look at how the company has validated or determined or calculated this, and the calculation should be re-performed by the auditor. So when I'm saying how you will arrive at your audit evidence, there are a lot of audit procedure. One of the audit procedure is re-performance, because it's being done through Excel spreadsheet. After evaluating the controls on the Excel spreadsheet, you also validate how this end-to-end reconciliation on the numbers flowing right from the source to the final calculation, which is being captured as part of revenue recognition. You have to look at that particular aspect very, very, very clearly. So the AAR model is another interesting factor which the auditor has to audit for the purpose of NBFC. Interestingly, on the other side, as of now, Ind AS is not notified for banks. But at the same time, RBI is asking to file provisional half-yearly Ind AS financial statement prepared by the management of the banks with RBI. In one of that provisional Ind AS financial statement, I have seen that they are not making any adjustment for AR model. In fact, I raised a question, how the consultant has considered this, whether the Indian Bankers Association has taken any conscious decision that this will be considered as upfront income only and not for servicing the loan over the repayment period. So that's a little bit of different scenario for banking companies. Maybe we will get a guidance when banks or banking companies are required to adopt Ind AS over a period of time. When it is notified, it could be possible. And of course, all other income has to follow the principles of Ind AS 115. So how the revenue recognition criteria is being met is what you have to look at. Nowadays, banks are not only just doing their banking operations. Similarly, the NBFCs are also not doing just the banking operation. They also sell some cross products. For example, when there is a requirement of insurance for their borrowers, they are tying up with an insurance company and offering the insurance activity also. For that, they earn some income. And similarly, they do certain additional activities for valuation or other activities, or there is a cross-sell of the items which they do for their clients in various aspects, and how the cross-sell revenue is being recognized in the financial statement also is the audit procedure should look at. And when I am looking at the expected or effective interest rate model, another aspect which I have to look at is not only the processing fees, but also there is a chance of acquisition cost. One is a processing fee I am collecting upfront. The other possibility is that I may be engaging some agents who will get me the loan portfolio or who will acquire the customer account to me. For that, I am paying them some commission, or we call that as an acquisition cost. This acquisition cost is also not an immediate expenditure. Like a processing fee, that should also be spread over the period of the loan. And accordingly, the effective interest rate model should consider this aspect as well. Another area of expenditure is employee benefits. You may ask that from revenue from operations, I have straight away gone to employee benefits. Why not the interest expenditure? Interest expenditure, anyway, we have covered as part of debt securities and other borrowings. So naturally, it will be, if they are deposit accepting NBFC, the fixed deposit interest, etc., might have been totally considered. But the point which I am trying to say is that we are already considering the liability side. So naturally, the expenditure might have been taken care. But the next important expenditure which an NBFC may be incurring, and the possibility of some judgment involved in those areas could be employee cost. What is that? Is basically the majority of the banking companies, NBFCs, both of them are trying to retain high talents. I've seen cases where a person who is in NBFC sector normally has an employee period or life cycle of 5 years or 6 years maximum. And he moves on to another NBFC or another banking company, etc. Because they believe that that is the way in which the employee changes himself so that his income can be increased. So to retain the high talents, majority of the NBFCs, especially listed NBFCs, are now giving what we call it as the employee stock option. The moment employee stock option comes in, the next important question is it an estimate? Even though Ind AS 102 is talking about how you have to value your ESOP charge to your P&L account over the vesting period, whether it's a significant estimate, the answer is yes again. Because ESOP requires the fair valuation of the options on the date of grant. So it requires a lot of valuation techniques to be applied, a lot of estimates to be included, a lot of assumptions to be applied. So accordingly, how the ESOP valuation has been done should also be properly audited by the auditor of an NBFC, because it will be a major charge to the P&L account. In fact, we have seen that one NBFC which was under AS and moved on to Ind AS in 2019, 2019, when they crossed that 500 crore net worth mark for the first year. They had the problem of major adjustment come under Ind AS was relating to ESOP accounting. So ESOP accounting we have to be very clear that it's a significant estimate. Similar to that, other significant estimates and judgments could be relating to gratuity liability, compensated absences, accrual of incentives, accrual of performance bonus, accrual of annual bonus. All those things could be possible. Look at the estimate relating to employee benefits. So I'm not dwelling upon all these items for a simple reason that we are familiar with how employee benefits should be accounted for as per Ind AS 19. So it's more of an accounting principle, but that accounting principle, when we were relying on the work of an expert, another standards on auditing comes into the picture. So we have minimum requirement of validating the base data and reconciling the base data with the books of accounts, from where they are giving that data to the actuary to work out that number. The second is what is the policy relating to employee benefits by the entity, whether the policy is being considered for the purpose of accrual. For example, in respect of compensated absence, I have seen in one NBFC, they simply have the principle of giving the encashment of the entire leave outstanding as at the financial year end in the immediate next month. So for example, March, there is a carry forward of say 8 days or 10 days of leave balance for each of the employees. In April month salary, along with that 8 days of salary is being fully given. The moment they are giving the complete encashment immediately in the next period, that is within 12 months from the period in which it accrues, naturally that becomes a short-term employee benefits. The moment it becomes a short-term employee benefits, there is no discounting which is applicable, or there is no actuarial valuation which is applicable. So it has to be on actual liability basis. Have you looked into your employee policy into that? I have seen another case where the employee policy makes it very clear that the employees have to avail all the compensated absences within the year and there is no carry forward permitted or no encashment is possible. So that means no vesting, no accumulation. In that case, no liability arises after 31st March, right, for the particular year. The third possibility could be a scenario of entity's accounting policy or HR policy says that we will give you a medical leave, or what do you call it as a sick leave, but the sick leave will be available to you over a period of say 180 days. You can carry on and adjust over 180 days, but you will not get any encashment for that. So a lot of cases I have seen where there is an error in the judgment by the company, or sometimes if the auditors are also miss out, is that sick leave is not being assessed properly as long as there is an accumulation which is permitted, and that accumulation can be adjusted against the future absent. Naturally, there is a liability. Only if it is non-vesting and non-accumulation, then only you can talk about not making any provision for the liability. That is another look at. The next aspect is relating to incentives and bonuses, especially where it is linked to the performance of the entity. So for example, if they are saying that the bonus is 20%, out of which statutory bonus is 8.33%, and the balance is considered as a performance-linked bonus. And the policy says this will be payable at the discretion of the management, and that too only to those employees who are on the rolls on the day on which it is declared. So some companies initially had the feeling that it's a discretionary and accordingly no liability arises unless the management decides. So that means in the year in which they have actually decided and paid, they only recognize that particular amount. That is not correct according to the standards on auditing, because it's a liability which is accruing based on the present situation. And of course, even if you are reading with what we call it as Ind AS 37, there is a legal obligation and another is a construction obligation. So you are having created a valid expectation in the minds of your employees that you will minimum pay 20%. Maybe you will call it as 8.33 now, and the balance will be paid as performance-linked incentive bonus, performance-linked bonus. And the similar to that could be a performance-linked bonus. So what is major assessment the auditor has to do when auditing those numbers is understanding the policy of the company, the eligibility criteria, and the eligibility criteria is to be accrued for the current period or not, and validate those particular items. And of course, some other provisions relating to employees and based on the actuals, whether any reversal is required, etc., should also be validated by the auditor as part of the major focus area. And of course, the finance cost is what we have already discussed: interest on loans, interest on debentures, interest on lease liability. The interest on lease liability, I will come to that a little later. Interest on deposits, if it is there, that will also be part of that finance cost. We have already discussed that at length. On the asset side, one more area where we normally consider is the property, plant and equipment in respect of an NBFC. The reason behind that is very simple. Majority of the NBFCs will have branches. They may not be operating only in one place. They may be operating in various places. In the various places, they have to actually create some infrastructure. That infrastructure may fall into category of leasehold improvements. They may fall into a category of furniture and fixtures. They may fall into the category of office equipments, or maybe some plant and machinery, whatever you call. And accordingly, what is the classification for the assets purchased, and what is the economic useful life for the assets, and what is the residual value of these assets? Again, is a calculation of an estimate or audit of an estimate. And of course, there is a requirement to validate this in accordance with the Companies Act 2013 also, because Schedule 2 prescribes what is the estimated useful life, or maybe it shows what is the indicative or illustrative economic useful life for various types of asset. And it is also indicative that the residual value could be 5% of the original cost. However, Schedule 2 says, in case if an entity is adopting or determining a different economic useful life, say for example, as per Schedule 2, if the economic useful life is 10 years, but the entity wanted to depreciate over 15 years, or it wants to depreciate over 5 years, whether it may be higher or lower period within which they will depreciate, or maybe higher charge of depreciation or lower charge of depreciation will happen compared to when you adopt the useful life under Schedule 2. But in both the circumstances, Schedule 2 requires that if a different economic useful life other than what is indicated in Schedule 2 is applied, a justification for the same should be part of the financial statement, as explained in the notes on accounts of the financial statements. So accordingly, that also the auditor should estimate. But normal mistake which we now do is only where the estimated useful life is higher than what is given in Schedule 2, we apply that. Whereas even if it is applied lower than what is given in Schedule 2 and higher depreciation is charged in the P&L, we should give the justification. The depreciation may be WDV method or maybe straight line method. However, the auditor has to definitely look at whether these items have been reperformed. Whatever depreciation the company has charged is being reperformed. Another requirement under the Companies Act has to look at whether the company is maintaining proper records to show the situation of fixed assets, etc. Quantitative details of fixed assets, we call it as a fixed assets register. Whether it is maintaining proper records or not is the next question which we ask. And accordingly, under the Companies Act, the auditor should also validate whether proper records is being maintained and it is being reconciled with the books of accounts or the financial statements. So not only reperformance of the depreciation is enough, but also looking at the FA register is also very important. There could be some specific scenarios which may arise. One is impairment testing, and the second is leasehold improvements. Leasehold improvements is a simple understanding, so I will just explain that. When an NBFC opens branches in various places, need not necessarily all the branches will be owned, the premises will be owned by the NBFC. It may be on leased premises. Because it's a leased premises, there could be a possibility of lease accounting under Ind AS 116 arises. We'll look into that a little bit later. But the question is, when I create an infrastructure or I create an office with some fittings or improvements in the leasehold premises, I take a shell premises and then I decorate with interiors, furniture, fixtures, etc. That leasehold improvements, how it should be depreciated, should also be an important consideration. Two aspects I normally suggest the auditors of NBFCs to look at is one, the lease period or the estimated useful life, whichever is lower, because it comes under the accounting standard. You cannot depreciate beyond the lease period. For example, if I have taken the entire premises on lease only for 2 years, but my estimated useful life is 5 years, I cannot depreciate over 5 years period, because at the end of the lease period, I may be vacating without even able to take over the leasehold improvements because they are fitted into the premises. And when I'm removing it, it will not be even having a scrap value. So accordingly, lower of the lease period or, and of course, I have to look at what is the estimated useful life, whichever is lower, I have to apply. Interestingly, the lease period, we have to assess one important aspect, whether the lease period is what is initially mentioned in the lease agreement or if there is a clause which allows the lessor to extend it or lessee to extend it further, whether that extended period should also be factored in determining the lease period. And of course, again, this is coming from the accounting standard. But as an auditor, we have to look at this because the leasehold improvements, instead of taking initial period of 5 years and additional period of 5 years, 10 years, if I depreciate only based on initial period of 5 years, my depreciation charge will be lower with respect to leasehold improvements. And to that extent, the current year profit is materially misstated. So accordingly, I should look at what is the terms of the lease. In other words, the agreement should also be validated by the auditor or audited by the auditor. So the key contracts entered into relating to leases should be audited, and gist of those leasehold agreements should also be maintained in the audit documentation the auditor should have. So that will help him to determine whether the calculation has been done properly or not. The second aspect is, some of the cases, the NBFC might have decided to close down some of the branches. See, for example, if I have 100 branches, out of which I believe the business is happening only in 80 branches and 20 branches are not successful or they are not earning what is originally planned. And accordingly, they are becoming a cost center. They might have taken a business decision to close down the particular branch. The moment a particular branch has been decided to be closed down, the question of impairment testing on the assets situated in that particular branch is also coming in as part of your audit consideration. Because you have to see whether the asset can be interchangeably usable in another branch. In that case, you can move and you can depreciate in the same old rates, and absolutely no problem. If it is not interchangeable, then there is a requirement for impairment testing and it has to be adjusted in the financial statements. Some of the NBFCs are, instead of using the word impairment testing, they decide for accelerated depreciation based on re-estimate of the useful life or re-estimate of the leasehold premises, lease term reassessment, because I'm going to close down in the next 1 year. So even if I have a useful life of another 3 years, they believe that the period for which I have to depreciate will be current year and next year, and accelerated depreciation on the carrying amount is being done. You know pretty well, when we are doing a change in that useful life, it's only a change in estimate, and accordingly, no requirement to retrospective adjustment is required. So the carrying amount has to be depreciated over the remaining estimated useful life, as simple as that. Capital work in progress in NBFCs normally will be rare, but I have seen in some of the NBFCs where they have acquired their own corporate office, it may take longer time, whether the capital WIP which they are having is recognizable as a capital asset is what we are supposed to look at. So that is one important aspect. Now, one item which I have missed out, or maybe I have intentionally missed out, is depreciation on right of use asset. This depreciation on right of use asset, I will pick it up along with the first item in others category, lease accounting. And then I move on to the audit of the other aspects, compliance and taxation. We have started with talking one important aspect. The audit of NBFC, the major concentration will be, other than the accounting aspects, mainly on compliance aspects, especially compliance on the regulatory framework in which the entity is operating. That regulatory framework could be two. One is Companies Act. So whatever provisions applicable to NBFC, whatever provisions applicable to a company will automatically comes into the picture. You have to look into all the aspects, including the directors, auditors, borrowing powers, related party transaction, etc., etc. You have to look at all the aspects. Suppose if it is a listed entity, because we are talking about Ind AS companies, listed entities, SEBI LODR whether that compliance has been properly taken care or not should also be there. I have not actually included here, should have been part of that. So if it is a listed NBFC, then SEBI's LODR and SEBI regulation should also be looked into. The third aspect, or maybe I should say that very first aspect is compliance with the RBI prudential norms and other circulars, and RBI's master circulars, RBI notifications, RBI's monitoring principles, etc., as we have discussed at the start of the session, should be looked into. Compliance with the direct and indirect taxes as applicable to any other company, this will be applicable to NBFCs as well. And of course, when you are talking about direct taxes, compliance with the income computation and disclosure standard should also be part of it. Other areas where the auditor should focus on is the lease accounting under Ind AS 116. Lease accounting mainly comes out of leasehold premises or branches which are operating on leased premises. So lease accounting says that if there is a right of use for a period more than 12 months, then you have to estimate what is the fair value of the finance liability which you have to repay over a period of time, and equivalent to the finance liability, there should be a right of use asset recognized. The right of use asset should be depreciated over the lease period on a straight line basis. The lease liability should be considered as a liability, and when you are repaying or monthly rent is being paid, the rent will be treated as a repayment of principal as well as the interest. So the lease liability, you have to accrue the interest on that, and then the rent payment should be allocated between the interest payment and the lease liability payment. Then this accounting will come into the picture. Okay, so this right of use asset, lease liability, and lease accounting as per Ind AS 116 is also, I have seen that one of the major area of activity or focus area for the auditors, because in some of the cases, the finance liabilities runs into crores of rupees because of the number of branches. Here, Ind AS 116, I don't want to deal elaborately on that, but the audit angle alone I will talk about. Necessarily, the key lease agreements you have to validate, and wherever they have worked out the lease accounting and what is the charge of interest and what is the depreciation on right of use asset, as an auditor, you have to re-perform those items definitely. When you do that activity, some of the leases may not fall into the category of right of use asset. For example, the terms of the contract, lease contract may be like this. It says that either party can serve a notice of 3 months and terminate the contract. In that case, lessor can also serve a notice of 3 months. Lessee can also serve a notice of 3 months. When the lessee will be, that is, the company will be serving the notice, is within your control. But when the lessor will be issuing a notice for termination of the contract, it is not within your control. And accordingly, there is no control over the use of the asset, or there is no right of use of the asset which can be controlled over a period of more than 12 months. And to that extent, it will not be falling under Ind AS 116. In that case, whatever rental paid will be normally charged to the P&L account. Okay. You have to look into that various lease contracts and what is the terms, whether they create a right of use asset and lease liability as well. And of course, the moment you are creating a lease liability, you have to also present them as what is repayable within 1 year, what is repayable within, more than 1 year, between current lease liability and non-current lease liability. One mistake which I have actually seen in many of the cases is that when the current liability is being determined, they simply take the total rent payable for the next 1 year and consider that as a current liability. Actually, no, because your lease liability is net present value of your lease liability payable over the lease term. The rent which you are paying is consisting of repayment of your principal, that is a lease liability, and repayment of the interest on the lease liability. So accordingly, the interest portion should not be reduced to arrive at your current liability. So I simply suggest people, from your working, you can pick it up what is going to be the lease liability for the next year, that is 2024. For example, if I am auditing 2023 and reduce that with 2023, the balance is your current liability of lease, and the remaining amount of lease liability will be your non-current. Simple way of doing it. Direct acquisition and securitization we have already discussed. The next area of audit is deferred tax accounting. You know that deferred tax accounting comes with a lot of assumptions. It requires your deferred tax to be accounted only based on the concept of probability of future taxable income available. And all those things should also be applicable squarely for an NBFC. There is no specific point which we have to consider. Other than that, the amount involved may be much higher. The only point which I wanted to add additionally is that in an NBFC side, the timing differences may arise in respect of expected credit loss, because whatever provision you are creating under expected credit loss in the P&L is not allowable under the Income Tax Act. So to that extent, there is a timing difference or temporary difference, whatever you call. The second could be because you are following Ind AS and do a fair valuation of your investments, there could be a possibility of your carrying amount of investments vis-a-vis what is available for adjustment as cost under the tax laws could be different. And to that extent, there could be an additional thing which may come. Other than this, and of course, the third one is relating to your lease accounting, because your lease, under the lease accounting, you are claiming interest on lease, you are claiming depreciation on right of use asset on the assumption that you have the right to use the asset. But under Income Tax Act and ICDS, you are the lessor is considered as the owner, and accordingly, you will not get the depreciation, you will not get the interest on the notional interest on lease liability. So that should be readjusted. And accordingly, in the computation, you will get only the rent, actual rent paid. So it may be higher in certain cases as well. So that will also result in your deferred tax impact for the purposes of an NBFC. Three aspects may be significant items. One is your lease accounting. Second is your fair valuation of financial assets and financial liabilities. And the third could be your expected credit loss, which you are looking at. The presentation of financial statements is also a concern for the auditors of an NBFC, because Schedule 3, Division 3 has prescribed a format of the financial statements. It is not the exact format of a financial statement of a normal company, where it is non-current versus current, whereas this will be based on liquidity basis presentation. And to that extent, the presentation requires a lot of understanding and proper disclosure. So that should also be properly audited by the auditor. So that brings me to key aspects of areas to be considered for an audit of NBFC. For want of the timing, because you know that the subject itself requires at least a 1 day full deliberation, picking up each and every item, assets alone separately, liability alone separately, estimates alone separately, RBI circulars and laws and regulations separately. But because the point which we wanted to emphasize from the WSB is key consideration in an audit of NBFC, I thought that we could cover the key areas of concern which may have a material impact on the financial statements of the entity. So if there are any questions, I will take those questions. And this is my contact details. This I will share with WSB. They will also share with all the participants of this particular webinar. So I'm stopping the sharing. And if there are any questions, I will take those questions.
Thank you so much, sir. Can you hear me, sir?
Yeah, sir.
Thank you so much, sir, for such a detailed deliberation on this NBFC. Sir, I have received certain queries. If
Yeah,
you
please.
permit,
Yeah,
I would
please,
like
please,
to ask those queries, sir.
please.
Sir, one member is asking how NBFCs can be evaluated by small investors.
How the NBFCs can be benefited by small investor.
Evaluated. If small investor wants to evaluate the NBFC.
Evaluate NBFC. Okay. Of course, when we are talking about NBFC and evaluating the NBFC, it's like evaluation of the, maybe I can say that the asset quality is the normal consideration when we were looking at with respect to valuation or evaluation of an NBFC. The second aspect is what I have not actually covered that as because I wanted to cover the key aspects of balance sheet items. These two items are normally we have to look at when you wanted to evaluate a particular NBFC for making your investment into that. The problem which you may have is that if it is not a listed entity, all the information may not be publicly available. And if it is a listed entity, the information, including the investor presentation, analysis, etc., will be very detailed guidelines will be available, which you can use it for the purpose of evaluation and make your investment based on that. Asset quality is the major aspect. And of course, you also look at year-on-year growth, etc., etc. But I believe that asset quality is a major issue because in majority of the cases, what I have seen is NBFC was doing very fine, but all in a sudden, there is a fraud in respect of one particular portfolio or maybe a branch. It washed out the entire profitability. And accordingly, how the asset quality is being maintained is the major parameter which anybody will look into that. Apart from that, what is the return of investment, the return on assets, etc.
Yes, sir. Sir, another question is relating to the internal audit. Member is asking how internal audit uh, is effective for the NBFC. What is to be done in case of the effective NBFC internal audit? And what is the major role of internal audit in case of NBFC?
In fact, we have seen that internal audit is actually contributing very effectively for NBFCs for two reasons. One, the volume of the transactions cannot be fully covered in a statutory audit. And the second is the process related deviations which the NBFC is having can be assessed only by an internal audit. And thirdly, any possible fraud or potential fraud or maybe a fraud which has been already committed will be unearthed immediately by internal audit. I will just give a small example. Interestingly, internal audit of an NBFC is requiring much higher talents, skill sets compared to doing a statutory audit of an NBFC, because every moment there could be a possible issue. For example, income leakage can happen. Somebody might be embezzling the amounts. Let me give a simple example. One of the NBFC's internal auditor is actually fixing a parameter for each of the branch. And they call it as a short audit or an alert audit. And if the parameter moves out or maybe deviation happens, they are marking a flag that it is not a normal branch. There is the risk is increased from low to medium and medium to higher. And they are deep dive into that particular branch for doing very detailed audit. This is one thing which, one example which I can share. Another interesting factor in an internal audit, I have seen that what effectively they have contributed is that they have seen the collection from the field and how that has been accounted in the books of accounts of the NBFC. Is there is any time lag between these two? Maybe genuine or maybe intentional. So accordingly, in some cases where they have found out that the collection team collects the money, uses it for some time, maybe after the second day or third day they are depositing, they have come out with certain guidelines. One guideline which they have talked about is that traditional, whatever collection should be immediately deposited in the next day, all those things. But if there is a deviation, how it can be identified? Now they have identified that the better way of controlling this will be through a digital payment. So the internal audit has gone to the extent of suggesting, can we have a handheld device for making digital payment by the borrowers, even at the field level? So using your debit card or whatever card you are having. So the digital payment collection, if it is increased, the possibility of fraud or possibility of teaming and lading can be avoided. And for doing this, they have also suggested an interesting factor. Can we give a cash incentive for the branches which are achieving higher digital collection compared to the previous month? Month on month, the collection percentage is increasing. So this is a simple example of how internal audit can very strongly support an NBFC because process deviation, immediate issues relating to fraud, etc., can be very easily identified. And apart from that, RBI is specifically saying that the company, NBFC, should have a very strong internal audit team. They are questioning the size of the internal audit team, the quality, the skill sets of the internal audit team, whether they will be able to cover the entire branches or entire operations of the NBFC for every quarter or maybe on a specific periodic time. So the RBI also gives, that is the reason why they have given risk-based internal audit system as one of the process. So internal audit can contribute significantly to an NBFC. In fact, in some of the NBFCs, the internal audit is being done through an internal audit team within the organization. And they are also outsourcing a portion of the activity by employing an external internal audit team. Both are being done on a parallel basis so that the effectiveness can be achieved in a better manner. So internal audit is a very critical, and a lot of professional opportunity is also there.
So one member is asking again, you have covered in your presentation, the provision as per the IRAC norms versus Ind AS 109 relating to the treatment of excess or deficit provision.
So if there is an excess provision as per IRAC norms, say for example, the provision which I have worked out as per, in my books, I have a original provision as per AS, which is, say for example, under the IRAC norms, I have created a provision of 80 crore. When I am transitioning to Ind AS, I worked out the provision requirement as per Ind AS 109 expected credit loss, which comes to only 90 lakhs. So, sorry, 100 lakhs versus 90 lakhs, let us assume. Whether the 10 lakhs is an excess provision which I have to reverse because I am following Ind AS, why should I worry about IRAC norms? But RBI made it categorically mentioned that excess provision as per IRAC norms should be moved to a special reserve. You cannot reverse it to income. At the same time, if the provision required as per your 109 is higher, for example, it is 120 lakhs, whereas your IRAC norms has a provision in the books only 100. The incremental provision has to be made in the books of accounts as per 109. So they are making it very conservative. Excess provision should not be credited to the P&L account. It should be only maintained as part of the reserve under IRAC.
Yes, sir. Sir, company is booking EIR on PF and adjusting with interest income and fees expenses through calculated on EIR basis, but shown separated in the financial statement as expense. Is it in compliance?
Sorry, come again, Anil sir.
The company is booking EIR on PF and adjusting with interest income and fees expenses through calculated on EIR basis, but shown separately in the financial statement as expense. Is it compliance?
So,
is it in compliance?
To understand your question, the expected interest rate model has been used both for income as well as expenditure. The company is presenting them separately. One as an income, one as an expenditure, correct? Whether that is correct or not is a question. In an NBFC scenario, I believe that for your revenue also, EAR model will come into the picture. And for your expenditure, for example, if you have taken in NCD or maybe other loans at below the market rate, there could be a possibility of charge for AR model will also come into the picture. So both are not to be netted off according to Ind AS 1 as well as read with Ind AS 109. Showing as a separate items on a gross basis will be a correct presentation, because one is relating to income relating to separate financial assets, and another is relating to financial liability. So net off would not be possible under 109 as well as 101. Sorry, Ind AS 1.
Sir, is depreciation allowed for tax purpose on leasehold improvement expenditure incurred?
Leasehold improvements, yes. The point is under the Income Tax Act also it is available, because I will, maybe the question comes in because of only one reason, if I'm not wrong. If I have considered that as a leasehold land, whether depreciation under the Income Tax Act is allowable or not, could be making them to have this question. If it is a leasehold land, land never gets a depreciation, and accordingly leasehold land also amortization only for the books purposes, but not having any impact on the income tax depreciation. But leasehold improvements is nothing but interiors which are fitted in the walls or fitted to create an interior ambience for the company. And accordingly, it is part of the assets of the entity. And to that extent, it can be classified as furniture and fixtures depending upon the nature. For example, if I have created a partition or I have created a false ceiling, I can call them as leasehold improvements. Within that category, I can, even if I wanted to have under furniture and fixtures, and what are all the assets I have added, I might have put it in electrical installation. All those things are possible. Since if I put it under electrical installation or the furniture and fixtures, my control over the depreciation under the books will be lost. So I call that as leasehold improvements. So accordingly, leasehold improvements will get the benefit as like a furniture under the Income Tax Act. We claim that there is no audit objections or income tax assessment issues have come so far.
Sir, practically the interest and lease payments over a period is not equal to the lease liability created. Then at the end of the year, how to nullify the LL account?
Okay, this may arise only if there is a change in the lease terms. Otherwise, assuming that I have entered into a lease for 30 years and my right of use asset is also created for 30 years, and my lease rent is prefixed, say for example, for the first 5 years so much, second 5 years so much, third 5 years so much, like that. If it is prefixed, there is no modification which is happening. At the time of I am working out the lease liability, net present value of the payments which I am anticipating over 30 years period is very clearly available to me. To that extent, there will not be any impact. At the end of the period, everything will be zero. The problem may arise only where there is a change in the lease conditions. For example, during the COVID period, what has happened was the lease rents are not being paid. And after negotiation, the lessors have given concession for them. So accordingly, the lease standard also has one thing called lease modifications. So whenever there is a lease modification criteria comes in, there are some conditions under Ind AS 116. If that condition is met, you will reassess the carrying value of your lease liability and your right of use asset to that extent. And accordingly, the lease liability will be restated, the impact will be carried forward. And if you are really following the modification on a consistent basis properly, at the end of the lease period, everything will be zero. Normally, we miss out this modification because dynamically following this number on lease wise, or maybe every lease for small modification, whether I have to make a change, because of that happens. In that particular scenario, at the end of the lease period for each of the leases, the amount outstanding may not be significant, or maybe I can use the word not material according to SA 320. So even if you are charging on that last year, it may not be having any impact on the financial statement. It will not have any requirement to consider anything on your audit opinion as well.
Sir, two more questions, sir.
Hmm.
Sir, due to the limitation of the software, amortization of EIR for PF income and commission expense is being done separately. How to address this?
In other words, this is what I'm trying to say. Software-driven calculations, if it is available, it's very easy for us to do only the IT general controls and application controls on the software, and the patch between the software and how the entry is being flowing to the books of accounts. That is a financial accounting software. Very easy. But normally, the practical situation is what is being asked by the queryist is that they will not have the complete software available. So majority of the cases, they will be doing through an Excel spreadsheet. Because Excel spreadsheet come to the picture, all the possible errors, omissions, and intentional adjustments could be possible. Auditor should be much cautious and has to validate the Excel spreadsheet working on a year-on-year basis. So that is very important. That is the reason why I'm saying that the knowledge of data analytics is very critical for the auditor. The knowledge of the data tools and maybe Excel spreadsheet like that is also very important for the auditor. Really, it is a practical issue, but the auditor has to live with that, no other alternative. Focus will be more on that particular area. So the control over the spreadsheet is what normally the auditing standards suggest. If somebody is not making any modification or the input fields are frozen, you cannot manually do any adjustment. And automatically, once you have initially added that, and when modification is happening, it is happening only with the control or maybe through an authorization matrix, then only the spreadsheet can be adjusted. So if those controls are existing, there is a possibility that you don't have any issues. Otherwise, on a regular basis, that is the reason why I use the word, you have to re-perform the working and have to have your comfort on that.
Yes. So last question from the investor point of view, one member is asking, please put some light on what factors we should take into consideration as the risk factors while dealing or investing in NBFC.
Okay. In other words, maybe the question is, if I'm rephrasing the question, the
which areas to be looked after as risk
where
factors?
they have given a loan, could be a possible risk sector. I don't want to generalize a particular sector on this, but however, every NBFC as part of their governance process because there is a requirement to have a risk management committee, RMC, and they have to look at all the aspects of risk, right from the operations, advances, recovery, how they are monitoring the loan portfolio. Everything has to be monitored by the risk management committee, and there is a risk officer specifically to be appointed in accordance with the RBI requirement. There is a specific risk management officer has to be appointed. And that area, they normally have their own assessment of, based on their past experience, based on the peers' experience, what are all the industries which will be having the possibility of repayment not coming on time. That will be the guidance for the auditor to look into that more specifically for the particular NBFC, and then look at what is the peers are there. Because if I generalize, for example, if I'm talking about an industry, real estate sector is risky, then people will say that some of the NBFCs are doing very good at real estate sector. So it is more of the portfolio and how the risk management policies are addressing and internal to the company, and also how the general perspective is being done. Because I have seen in one case, they are worried too much on lending on agriculture sector. NBFCs are very reluctant to give loans on agriculture sector. Whereas the same NBFC after 3 years have purchased through direct acquisition a portfolio of agricultural loans, because they felt that that is more the repayments of loans are, since the sincerity of the borrowers are much higher compared to some of the risky portfolios which they are holding. Unsecured is one of the issue relating to NBFC, unsecured loans. And accordingly, to that extent, we have to look at what are all the portfolios which are unsecured, and those sectors per se in the economy, whether they are risky. That may be the assessment. I don't want to generalize a particular industry as a risky sector.
Yes. So thank you so much, sir. We now come to an end. And thank you so much for
Thank
the wonderful
you to you,
dedication.
Anil,
You have
Anil
covered all
ji.
the.
Thank you to the chairman of WASP and the members of WASP
Yes.
for giving this opportunity. And thank you to the participants as well for the patient hearing for nearly 1.5 to 2 hours on this.
Yeah,
topic.
it's almost 2 hours, sir. You have spoken for completely for 2 hours, and thank you so much from Auditing and Assurance Standard Board for acceding to our request. And you are always available for the cause of the profession, always available for the members for the knowledge dissemination. So once again, thank you so much for sparing your valuable time, sir. I also extend heartiest thanks to all the participants also, sir. Thank you so much, sir. Thank you. Thank you. Namaste.